Aloha. Sell put options for income. This video, ladies and gentlemen, will be how to sell put options for income in a really easy way for beginners. Let's get into it. Selling put options is a great way to earn some extra skrilla. Extra dollars, ladies and gentlemen, depending on the level of risk you are willing to take. You can earn various levels of return on investment. The strategy I'm going to be showing you, it doesn't have an exciting ROI until potentially later on down the road. And we'll keep that as a little mystery. So when you watch till the end of the video, you find out how you can take your little ROI and make it really, 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 really big. In this video, I'm going to be talking about selling cash secured put options for income. In selling cash secured put options, there's something important to do. Well, so number one, you need to select a stock that you wouldn't mind owning the rest of your life if you had to, and that you pick a price to purchase it at that you would be comfortable paying if you had to. When you do this, it gives you the greatest chances of not losing money. When you sell cash secured put options for income on a stock that you wouldn't mind owning the rest of your life if you had to, at a price that you wouldn't mind paying if you had to, then you're in the greatest position possible as a beginner to follow Big Buffett's rule number one. What is Big Buffett's rule number one? It's right here, ladies and gentlemen. Never lose money. Never lose money. That's what Buffett says. He says never lose money. So consider doing this strategy that will give you the greatest chance of following Buffett's rule number one. But I gotta warn you. I gotta warn you, as you go down this path, you will be faced with the treacherous inner emotions that we all deal with. And at that time, I pray you have the courage to remember and the wisdom and strength to implement rule number two. Don't forget rule number one. The first thing I need you to grasp is that one put option contract equals 100 shares of stock. Okay, one put option contract equals 100 shares of stock. This means you must select a stock that you can purchase at least 100 shares of. You must select a stock that you can purchase at least 100 shares of. If you select a stock that you cannot afford 100 shares of and you sell a put option contract on it, you are deviating from selling cash secured put options. You're either selling naked put options or you're selling margined put options. Either way, you're not selling cash secured put options. And when you stop selling cash secured put options, your risk increases, giving you a greater chance of violating Buffett's rule number one. Let's look at what Al Brooks has to say. The great traders control their emotions and constantly follow their rules. So follow the rule. Follow the rule. Pick a stock that you can buy 100 shares of. For this, I've selected a stock that you only need $1,000 to do this with. I'm not going to tell you what stock that is, but it's just to show you that it can be done. Let's take a look at that. Now here we have a stock that's currently trading around $11. This shows you the price movement. See all this stuff going on here? It's basically showing you the price movement over the last 6 months. So for the last 6 months, we've seen the lowest it's been is $7.78. The highest it's been is $12.48. And we see overall an upward trajectory here. Ooh, that word's tough for me. Let's look at the last 3 months of the price action. So here's the last 3 months. This green line right here This is the 200-day moving average. This number is basically derived by taking the average of the price movement over the last 200 days. So we see right now the 200-day moving average is at 1032. Now it's currently trading around $11, and our 200-day moving average is a bit over $10. So let's look at selling a cash secured put option on this particular stock at $10. Now what would that mean? Well, number one, we know that if we sell one contract, that we are obligating ourselves to purchase 100 shares of the stock. So we have to have at least $1,000 in our account. And from there, let's move in a little closer and see what we can find out. Right here is showing us different dates of these contracts. Now these contracts have expiration date. So right here it's showing us these different days that they expire in. You can see that we have this contract that is going to expire in 0 days. Is that already expired? It's probably going to expire this Friday. It happens to be on a Thursday that I'm recording it, so it's probably expiring tomorrow. We have another one that that is going to expire in about a week, 14 days. Obviously, I look more at these days than I do at the calendar, but whatever you feel comfortable with. Look more at the calendar date over here. For this example, and for beginning, and generally whenever I start selling cash secured put options on a stock that I'm not really familiar with, I'm learning that particular stock, I'll go with really short days. And depending on the situation of what's going on in my life, and another reason why this is a great strategy is that you can choose your length of expiration based on what's going on in your schedule. So say you're going to go on vacation. You don't want to have any trades open when you go on vacation. Well, then you pick the correct date. So there's a lot of ways that you can work around. So let's open up. Let's take a look at 7 days. Let's say you're just learning how to do this. It's your first time doing it. You want to have the trade open for just a week. So what will that mean? What it will mean that at the end of 7 days, at the close of business of May 27th, the stock price, wherever that stock price is going to dictate what happens next. Let's look into it a little closer. All right, so now we are looking at what's called the option chain. Now we're looking at the option chain that has expires in 7 days. One thing I want you to notice is that right down the center, we have a column separating these two different sides. On this side, you can see it's labeled puts. On this side, it's labeled calls. Since we are selling cash secured put options, we're going to be concerned with this side at the moment. Another thing that's probably standing out to you is that there's black here, and there's this kind of purple color here and this purple color here. That is basically right around this $11 mark right here. So what that means is that when you're on the put side, which is puts is about going down, you can think about when you're on the telephone, you put the phone down, and to take the call, you call up, right? So just keep that in mind. Put is about going down. So what we're going to do is Brent is going to stop overcomplicating it for you right now, and we're going to deal with put option with a strike price at 10, and we're going to leave this call stuff, we're going to leave that off to the side, because at the end of these 7 days, if the stock price stays above $10, you don't have to worry about this side at all. What will happen is that you will keep the amount of money you got from selling the option, and you'll keep your $1,000. If at the end of 7 days, if the stock is trading below this $10, then you will purchase 100 shares of stock. Then you're going to do something with the side. But until then, let's focus on this side right here by clicking this button, which is the lower of the two. See these two numbers here? One says 4, one says 5. When we're selling, we always go with the lower number. So let's click that and see what happens. All right, it pulls something up here for us, and it has pulled up this particular position that we're going to open. It's in red because we're going to sell, and it has negative because this particular broker, that's how they do it. We're going to be selling something into the market, so it shows that we're going to be -1. Now if we go up 1 to positive, it turns to green, and you notice that this changed to buy, right? So we're not buying cash secured put options, we're selling cash secured put options. So we need to bring it back down to 1, sell. Now if we were to go down to 2, that means we are making the legal commitment to purchase 200 shares of stock in a certain time frame under certain conditions. But if we only have $1,000 in our account, we're not going to do that, right? We're going to stick to following Big Buffett's rule number 1. We want to limit our chances of losing money. So we're just going to go with 1 put option contract. And you can see some information here. It's all details that we've kind of been going over. But to get to the nuts and bolts here, this is the price that we're going to sell it at. You notice it's 4 cents. Now 4 cents times 100 shares of stock, right? Because 1 put option contract equals 100 shares of stock. So 4 cents times 100 equals $4. Not exciting, right? That's okay. That is definitely okay. We talked about that in a slide earlier. So let's hit this confirm button and see what happens. Okay, now we got some stuff to look at here. Let's zoom in and take a good look at that. All right, now we can see this really clearly. This is what a Thinkorswim calls their order box or something. I have no idea what they call it, but this is ultimately the last step that we go through, and it is going to teach us a lot of stuff. So let's look at what's going on. We got the order description. We're going to sell 1 put option that expires May 27th. Notice it says 100 because it's talking about 100 shares of that underlying stock. Going to sell that. It's going to expire May 27th. We have a $10 strike price, which means that if this particular stock goes below $10, we're purchasing 100 shares at $10 each, and we are going to request from the market to give us a minimum of 4 cents, which is $4 for this. Now you see limit, that means a minimum. That means that we're telling the market that we are willing to do this for somebody. We are willing to make this promise to somebody in the market that we will purchase 100 shares of this particular stock at $10. No matter if it's trading lower than $10. We're going to be your insurance salesperson for the stock. And but we're only going to do it if you pay us a minimum of $4 for this time frame of 7 days. Now you can pay us more. We'll take more, but our minimum is 4. Below here talks about this break even. This break even price is $9.96. So if you add 4 cents to this, it's going to equal $10, right? And this part right here, this break even number, let's call this cost basis. For this particular strategy of selling cash secured put options, and selling on a stock that you wouldn't mind owning the rest of your life if you had to, at a purchase price that you're okay with if you had to buy it. This is going to become really important, is what the cost basis is. Now the max profit, they say, is $4. That is talking about just this transaction right here. Max loss. This says max loss because $996 is going to exit this account if the certain conditions are met under our time frame that we're selling this contract at. Now that doesn't mean that we automatically lose $996 worth of value. If you pick a good stock that you could potentially own for a long time, as long as the stock doesn't go bankrupt, it's very difficult for you to lose money if you're picking a good stock, and as long as it doesn't go bankrupt. But that's what that is referring to, is how much money is going to flow out of this account. Cost of the trade. So we're going to get paid our $4, but we have some 65-cent commission coming out. So assuming that this trade gets filled, we will have $1,003.35 in our account. Buying power effect, don't worry about that right now. Just realize that there's something going on that is more complicated, and that if you stick to cash secured put options, you won't have to worry about this. As long as you have the cash in your account to fulfill your obligation, you don't really have to worry about it. However, as you progress in this skill, over time, you can start implementing different strategies when you have a greater understanding of how to do all this stuff. So let's send it into the market. We hit send. It disappears from there. We can check over here. Now we see that it's ready. When the market opens, this order is going to be broadcasted out to the market, and let's see if we get filled tomorrow. If I get filled, I'll get some notifications through however you have your notifications set up. That's it, ladies and gentlemen. Selling cash secured put options is probably a lot easier than you think. Try it with real money. Try it with a paper trading account like I was doing here. You don't have to risk real money. You can do it virtually in a game type scenario to make sure you understand what you're doing before you start risking real money. And that is what you want to do. You need experience. You need to figure out ways to get experience, and you need to be learning, and at some time you need to use real money, so you're learning how to manage your emotions. So you can use a mixture of simulated trading, paper trading, and real money. When you're using real money, definitely in the beginning, stick to selling cash secured put options, so you're minimizing your chance of losing money. Now remember, I was talking about that break-even cost basis. So what ends up happening if you were to get assigned the stock? Let's say you had to buy 100 shares of that stock at $10. Well, as you saw on that little box when we were sending the order, your cost basis really is not $10. Your cost basis is $10 minus $3.35. $3.35 is what you got left over after the commission. And then what happens, when you're doing this, you're going to pick a stock that more than likely you're getting dividends from, and then you're going to start doing this next strategy that is called selling covered calls. And you're going to be bringing in more money that way. Every time you get a dividend payment, every time you sell a covered call, you subtract a little bit from that cost basis. So at the beginning, when your ROI didn't seem very exciting because you're getting $4 on a commitment of 1,000, what happens after, let's say you get assigned and it's been, let's say, 12 months you've had the stock collecting dividends and selling put options? What happens when your cost basis is not in the $9 anymore? What happens when your cost basis is around $7? Your ROI goes up. If you keep doing this long enough, eventually you will have pulled out, through dividends and selling covered call premium, you will have pulled out $1,000. So what is your ROI when you have zero money in the deal? The deal originally started at $10. You kept pulling money out. Eventually you have no money. You've recouped your $1,000 out of the deal. However, you're still getting paid dividends and you're still generating income from selling covered calls. What's your ROI? It's a bit of a trick question. Leave it in the comments if you know. And with that, I'm going to leave you something for free. I've got something for free for you. 3 underused tactics to transform your financial life. Pardon me, your financial results. I wrote it and I can't even remember what I wrote. So, ladies and gentlemen, this will either directly or indirectly help you with your trading. It's going to help you with anything. It's free. Get it. I'm going to give you a warning though. I will warn you. They're underused for a reason. They're underused for a reason. You want to start getting up in the higher tier of people that are able to transform their financial results. You want to start achieving things in your life at a higher level where other people are still looking around trying to figure out what to do. Consider implementing these tactics. 1, 2, all of them, however you want to do it. You can get them at ihavesuccess.com. You guys have a fantastic night and get out there and make some options trades.